Do you think the Standard & Poor's 500 index is currently overpriced? Because right now, ever since the war broke out, boom, bang, chaos everywhere. There have been people saying, hey, with things like this, the US market is definitely going to crash. But today, as this clip airs, I'm not even sure if the war has ended yet. Maybe it hasn't, or maybe they're still negotiating. But even in the midst of all these people saying, hey, the US market is definitely in a bubble. If it doesn't burst today, it'll definitely burst in a few years. But the S&P 500, from the beginning of May until about mid-month, hit an all-time high, guys. And it wasn't just any all-time high. It shot up from the most recent dip by 15%. And let me tell you, if you look back in history from 2009 up until now, there have only been 5 times when the S&P 500 chart has jumped up by 10% from a dip in such a short burst like this. And in all 5 of those times, every single time, the S&P 500 followed up with a nice upside in the following month. So if we just look at this chart and see that history tends to repeat itself, it should mean that, hey, the S&P 500 should be looking good. There shouldn't be anything to worry about, and maybe there's no need to even make this video. But do you know why I had to make this video? Because I'm not so sure, you know? So what's really going on? Is the chart actually misleading us? Because, okay, the stock market looks great. The S&P 500 even hit an all-time high. But when it comes to consumer confidence in the United States, right now, it's at the lowest point in the past 74 years. And that's what makes this moment different from the past. That's why I think it's important for us to look for information and see whether the S&P 500 is actually overpriced or not. And I say it's important because I know that a lot of people have put their financial future into the S&P 500, into VU. DC, or whatever you put here, is with the hope that you'll be comfortable when you retire. But right now, nothing is the same as before. Everything has changed. So let's look for information together to see if the S&P 500 is actually too expensive. You can support the information in this video about whether the S&P 500 is overpriced by scanning this QR code from the SciMoney Monster channel. Supporting the SciMoney Monster channel is super easy. Just scan the QR code. Leave a comment to chat with us, hit like, share, and most importantly, please subscribe if you haven't already. If you haven't subscribed yet, please do. Thanks. Let me say up front that even if you watch this video until the end, I won't be giving you a definite answer on whether you should sell off your S&P 500 or keep investing in it or stop investing altogether. But I do think this information is important. It'll help you understand whether the S&P 500 is currently overpriced or not, and that will be a part of what you use to make your own decision, whether to sell, keep investing, or decide how much of it should be in your portfolio. Are you okay with that? Let's start. Amidst all sorts of news saying that the US market is going bearish, it's going red, it's about to crash, the US stock market, specifically the S&P 500, which includes the 500 largest companies in the US, just shrugs it off and says, but I'm at an all-time high. And it's not just any all-time high. Take a look at this chart. It's bounced back 15% from the most recent dip, which, historically speaking, since 2009, there have only been 5 times when there was a bounce like this, where it jumped more than 10%. And every time, as you can see, it was followed by a nice upside for the S&P 500 in the following month. So really, if the market is this strong, there shouldn't be much to worry about. You'd think, okay, I can relax and just stay in. But still, that little voice of doubt always gets activated because take a look at another graph here. When you compare it, it's the consumer confidence graph, which is compiled by the University of Michigan. What's interesting is that consumer confidence is moving in the opposite direction, almost like it's a completely different story from the stock market. Similarly, the U.S. Index of Consumer Sentiment, the U.S. Consumer Confidence Index, has just dropped. And it's not just any drop. It's fallen to the lowest point in the past 74 years. Do you know what that means? 74 years. It covers everything from the assassination of John F. Kennedy, the 1973 oil crisis, the 9/11 attacks, the global financial crisis, and even the biggest COVID outbreak we just went through. But right now, consumer confidence is lower than during any of those major crises in the past 74 years. So, what's causing consumer confidence to be this low right now? Of course, according to Iran, because this war isn't just a regular conflict happening in one area, it's actually closed off the Strait of Hormuz. And everyone knows, it's been said many times, the Strait of Hormuz is the route for exporting 1/5 of the world's oil. That's a huge amount. If this supply disappears, it affects everyone. There's a writer named Martin Wolf who wrote in the Financial Times that the Strait of Hormuz is like the main artery of the global economy. It's a place where no war should ever be started without thoroughly considering the objectives, the methods, and the risks that could follow. What happened seems like there wasn't any careful consideration beforehand. So now the question arises, is the US market, especially the main market like the S&P 500, actually overpriced? Should we still be investing long-term in the S&P 500? The reason I picked up this topic for a video is because I know it's an important issue, and a lot of people are concerned about it. There are people who have put their retirement savings into the S&P 500, people who have entrusted their financial future to the S&P 500, expecting it to grow at an average of 10%, like it has over the past 100 years. But will the next 100 years be any different? Should we still be putting our money there like we did in the past century? To answer this question, I'm going to explain using a chart created by JP Morgan, not by me. What we are looking at here is a detailed chart that shows the forward PE ratio of the S&P 500, and it compares those figures directly against the actual returns that investors will receive over the next 10 years. The chart displays data from 1988 all the way to 2024. But before we dive into this chart, I would like to take a moment to first explain what the forward PE ratio means for those who aren't very familiar with it. To put it in technical terms, the forward PE ratio is the stock price divided by the expected future earnings per share, EPS. Still sounds complicated, right? Basically, it's the simplest way to ask, is the price we're paying for the stock right now too expensive compared to the expected future earnings? That's what it means. And it's not the same as the regular PE ratio either. The regular PE uses earnings that have already happened in the past. As for the forward P/E ratio, we compare it with the expected future earnings. That's why for many companies, the P/E and the forward P/ratio are not the same. Now, I'm not sure if you get it yet, but let's keep going with love and care. Otherwise, the clip will get too long, so let's continue. Now let's look at the graph. At the bottom, we have what's called the x-axis, and at the side, the y-axis. The x-axis at the bottom shows the forward P/E ratio ranging from 8 times up to 26 times. The way to look at it is through valuation, whether something is cheap or expensive. If the PE is low, it means it's not expensive. If the PE is high, then it's expensive. Got it? Next, let's talk about the vertical axis, the y-axis. On the left side, the y-axis shows the annual return rate that investors will actually receive over the next 10 years. It ranges from -30% up to +30%, and you'll see dots on the graph, shown as circles. The white dots represent actual periods in history when people bought the S&P 500 at those specific valuations, meaning at those specific P/E ratios, and then received those returns in the following decade. So you look at the vertical axis for that. What JP Morgan created here isn't a forecast, but actual historical returns. So on the left, you can see, okay, got it. You'll notice that the shape of the data, the graph, slopes from left to right very clearly. When the forward P/E is low, or when it's cheap, around 10 times, 12 times, something like that, you'll see that investors get higher returns, right? You can see it's around 15 to 20%, which means the profit they'll get over the next 10 years is quite high. And yes, as the graph slopes to the right, that means as the valuation gets more expensive, as the forward P/E increases, the numbers go up. The returns that investors will get over the next 10 years are even lower. And if we look at the far right point of the chart, we'll see that when the forward PE ratio goes above 23 to 25 times, the most expensive on this chart, you'll notice that most of the points in this group, the white ones, show negative returns for the next 10 years. That means people who bought the S&P 500 at this valuation over the next 10 years will actually have less money. In other words, in 10 years, they'll be at a loss. All right, so this chart made by JP Morgan, they mentioned that this is based on making a lump sum investment, not DCA, dollar cost averaging, just to clarify. So the question is, what is the forward PE ratio of the S&P 500 right now? So how much is it right now? Let's look at JP Morgan's chart. You'll see they drew a green line on the graph labeled current level, which means the current level is around 22. This chart was made a little while ago, but right now it's still about the same. The forward PE ratio of the S&P 500 is around 22. So let's look back at the chart to see during which periods the forward PE ratio of the S&P 500 was at 22. The expected return over the next 10 years is about +2 to -2%, which is considered low. At this rate, even a fixed deposit at some banks might give you more. So if you buy the S&P 500 today, like through an ETF such as BO or something like that, let's say you buy $1,000 worth today. In 10 years, your $1,000 might be $980, or if you're lucky, it might be $1,020. Just that. If these are the numbers, you could say that buying the S&P 500 right now might be buying at too high a price. If, in 10 years, the return could be a loss or just a tiny profit, then the price you pay today really matters because it's a factor that determines the rate of return we'll get in the future. If we buy something that's too expensive, more than it's really worth, we'll end up losing money in the future. But if today we buy assets that are priced lower than their true value, that's when our rate of return will actually be profitable. Now, about people saying the S&P 500 is too expensive, I'm not saying that myself, honestly. I actually got this statement from Paul Tudor Jones, who was one of the greatest macro investors of all time. Because in 1987, Mr. Paul, he was one of the few people who could predict Black Monday, which was one of the biggest stock market crashes in history. He got it right, and that allowed him to short the market and make a huge profit on that day, while everyone else was getting wiped out. Now, Paul Tudor Jones said that the S&P 500 has been an excellent long-term investment over the past 100 years, but today, if you buy the S&P 500 when the valuation, or the P/E ratio, is at 22, your returns over the next 10 years will actually be negative. Paul also said that valuation is extremely important, and right now, the US stock market is very expensive. So at this point, he calls it a time when it's hard to make money, even if you look at the long game. So up to this point, there must be a question. Well, then why has the S&P 500 delivered such good returns over the past 100 years? Well, that's because over the past 100 years, the economy has grown tremendously, like really, really well. You could say it was luck or skill, but mostly luck. I came across some information from the book The Unconventional Bankers by Manoj Pradhan and Charles Goodhart. They explained it like this. They said that the economy from 1990 up until now has been really good. This is what economists call the demographic sweet spot, the golden period of global population growth that has had a positive impact on the economy. There are a lot of factors involved, like the world population over the past 100 years, which has been on the rise and growing significantly. Just imagine, in a market where the number of people keeps increasing, it means there are more things to sell. So just having more people means the market grows more easily, right? Of course, skill still matters, but you don't need that much. More people means more demand, which means you can sell more. This is just a natural thing for the global market. And then there's the baby boomers entering the workforce. Plus, over the past 100 years, there's also been the movement to support women's education. And then women started to play a bigger role in the workforce, so there were more female workers too. And during this time, China entered the global market. Wow, over the past 100 years, China has become the world's factory. There was also the growth of the European and Japanese automotive industries. All of this really spread jobs all over the world. Even Thailand benefited from the growth of Japan's automotive industry. All of this led to a period where the global workforce basically doubled. But all these points I've mentioned only happened once in history. I don't know if something like this will ever happen again. So, what was the result of everything I just talked about? It was economic expansion, and governments felt really fulfilled. They were super happy about the economic growth and wondered what they could do to make it grow even more. Then they implemented quantitative easing, pumping money into the system to make it really abundant. And what else? On top of that, the world entered what's called the tech boom, along with the rise of supply chains. And what else? During that period, the world was still getting along. We had just entered the era of globalization not long before that, just a few years earlier. It was only before we encountered Donald Trump's tariffs. So all of this made that period. There were a vast number of people. The economy was booming, interest rates were low, financial costs were cheap, governments were providing support, there was quantitative easing, and employment was high. During 2018 to 2019, it was an absolutely remarkable miracle for the world. Many countries had the lowest unemployment rates in recorded modern history. And what exactly followed from all of that? What followed was that workers received good wages, because when the economy's big and everyone wants to hire, the unemployment rate is low, which means there are fewer workers left in the market, right? And labor is really no different from any other commodity. If there's a shortage, it becomes expensive. But if there's a surplus, it becomes cheap. So during times when the economy's booming, there's a shortage of labor and wages go up. Companies compete to hire workers. And then workers are able to earn a lot of money, so they have money to spend. When they have money to spend, they go out and buy things. All sorts of companies end up making a lot of revenue. And when companies make a lot of revenue, it shows up in their stock prices. This is called structural support. So this is one of the factors that made the economy grow over the past 100 years, thanks to the world's good fortune. But nowadays, that's no longer the case. Everything that's happening now and everything predicted to happen in the next 100 years is the opposite of what happened in the past 100 years. Whether it's the global human birth rate has been continuously declining. Many countries have already entered an aging society, which means that the baby boom workforce from the past 100 years has now become elderly. And as the workforce shrinks and the population decreases, markets with fewer people won't grow as easily as they did when the population was increasing, you know? But if we're going to talk about wow, in that case, the US market, will it lead to a bubble burst or bankruptcy or anything like that? I don't know. And in this clip, I'm not saying that, wow, the S&P 500 is going to zero, or that you should just bet against America and you'll get rich. I'm not saying that at all. I'm also not saying that the US market will crash today or in the next 10 years. So if anyone still wants to invest in the US, honestly, if you're not looking at the S&P 500, I think if we want to structure our portfolio, we should narrow it down by industry sectors. That is still a very real possibility. But what this clip clearly points out is that investing in the S&P 500 right now, when its valuation is at such an elevated level, or in other words, this expensive, it is likely not going to be quite as easy to make money in the future as it was in the past. But as for what it will actually look like, only time is going to truly tell us the answer. After watching this clip, do you think the S&P 500 is just too expensive right now? Go ahead and leave us a comment down in the section below.